Hey guys, welcome to another week ahead video. Now in this week, the market's attention will focus on the upcoming FOMC September meeting that's taking place this week. Now, like with all risk events guys, and like we saw with last week's ECB event and the up and down whipsaw that we saw in the euro from that event, it's always important to have a research-driven approach when it comes to risk events, especially if we want to be trading into or out of them. So what we'll do following up from last week's video in terms of this week's FOMC meeting in the US dollar, we're going to start off with the baseline expectations of the US dollar going into the event. Then we'll look at the baseline expectations for the FOMC event itself. And following that, we'll look at some possible big sentiment shifts that can occur from that meeting and what we need to be looking out for a possible trading opportunity on the dollar from the FOMC event. So let's jump to the video and have a look at some of the details. And guys, a quick reminder to click the button below to make sure that you are subscribed to the channel so that you're always notified of any videos that we release. Alright guys, so we're going to be following the same three-step analysis process that we introduced for you guys from last week. So the first step will basically be to find the baseline for the relevant currency. In this case, it's the dollar. Step 2 will be to find the baseline for the event, which is the FOMC. And then we're going to look at possible sentiment shifts that can create trading opportunities from the event. So the first step there, analyze the current baseline for the US dollar. Now, just to quickly show you guys that example again, how we got to this information. Within the Forex source terminal, we have the currency research tab. Within that, we have various research reports, and the one we're going to be looking at is the major currencies fundamental drivers report. So if we just quickly open up that, this is basically just a rundown of our bias, fundamental bias for each of the major currencies, as well as the reasons behind that bias. So if we just quickly jump to the US dollar, we can see that our current fundamental bias for the US dollar is neutral, and the following information explains why we have that neutral stance. So we saw that the FOMC at the July 31st meeting, they had that 25 basis point rate cut. Now that actually disappointed the markets because they were looking for a more aggressive 50 basis point cut. Now, we also had recent comments from Fed members that came across a little bit more hawkish than the markets were expecting, with a few exceptions here and there. And according to CME Fed Funds Futures, the markets are completely pricing out the possibility of a 50 basis point cut, which is very important. And there's been a little bit of a reduction in the 25 basis point expectations as well. Current prices imply a 80% probability of a 25 basis point cut and a 20% probability of a no change. Now we can just actually jump to CME Futures. Okay, and here we can see that expectations for a 25 basis point cut is currently at 84.2% at the time of recording, and the probability for a no change is sitting at 15.8%. Now, the markets expect a cut of 25 basis points, but there's a lot of chatter about this being a more hawkish cut. As such, we expect the US dollar to actually remain supported into the meeting and rally out of it unless the Fed does something surprisingly dovish. Okay, so that gives us our first step, and that is finding the baseline for the USD. Now we can do step 2, which is finding the baseline for the current FOMC meeting. Now, the markets has actually been pricing in this 25 basis point cut with a fairly high probability from about the start of August. So this week's rate cut is fully priced in at this stage. We also had Jerome Powell that spoke in Zurich recently, and he was the last speaker before the Fed started their blackout period, which is basically the period they start a week or so before they have the FOMC meetings. There's no interactions allowed with any press with the members. So that blackout period started with him. He was the last one to speak before it started. So he was basically the last Fed member to kind of re-guide the market's expectations in case they were looking for a slight change in their policy. But he basically didn't re-guide the markets at all in terms of current expectations. So in terms of going into the meeting itself, we can probably expect to have those two hawk dissenters again from the last meeting to keep their stance and vote for a no cut. So that shouldn't come as a surprise to markets this week. The markets also expect the Fed to stick to their previous comments that they will act as appropriate to sustain the expansion. Now, all of this just basically means that they will basically cut interest rates if and only if the economic outlook worsens for the US economy. So with a rate cut priced into the markets, the attention will most likely turn to Jerome Powell and his press conference to see what he has to say about the economy. This can also create a lot of volatility because we don't know what type of questions is going to be asked of him, and we don't really know how he will respond. So that is also something we just always need to take note of and make sure that we are paying attention to that press conference if we are in any trades in the dollar before that happens. Attention will also be on the Fed's dot plot to see whether the Fed members are now starting to price in more rate cuts or expect more rate cuts from the Fed in the next couple of months. Now, something that was important that I wanted to show you guys is Nordea Investment Bank actually came out with a couple of important developments, both positive and negative, which occurred since the previous FOMC meeting, which is important for us to know about. We know last week there was a couple of conciliatory remarks coming from the US and China with regards to the trade war, but we need to remember that the trade war did escalate directly after the July FOMC meeting, where both the US and China actually, after that meeting, introduced new tariffs and basically escalated the trade war. So we can expect that the Fed will see that as a more dovish development, and they did highlight the risk of the trade war as something that they are paying careful attention to. The second point is manufacturing. Now, manufacturing has continued to slow. We saw the ISM manufacturing dropping below that very important 50 level for the first time since 2016. So that should also be something that is concerning for the Fed. On the plus side, however, the services sector is still looking fairly healthy. So we have a little bit of a positive and a negative one going on there in terms of the economy. Now, the third one, which is important, wage growth and especially inflation has continued to remain solid. You guys will recall that inflation was one of the main reasons that Jerome Powell gave for the Fed making that dovish tilt a couple of months back. And recent CPI numbers have really been very positive, and that should be a positive development for the Fed as well. And the last thing that's important to note is the yield curve. We saw the yield curve invert in August, which is obviously after that July meeting. And we also know that a lot of the Fed members do pay particular attention to the yield curve, which many of them think is a precursor of a possible US recession. So that is something that can tilt some of the guys to a more dovish stance. So that is a couple of points that's important for us to take note of in the run-up for this event. So then we're going to move to step 3 and looking at any possible sentiment shifts that can create opportunities for us in the markets. It's important, guys, to remember that we are always looking for sentiment shifts to trade from, whether that is a positive or a negative sentiment shift. We want that sentiment shift to change that can create a volatility and a move in the markets for us to capitalize on. We have the baseline for the US dollar, we have the baseline for the FOMC, and now we can look at the possible things that can cause these sentiment shifts. Now, the first one is let's look at a possible hawkish shift. Now, the most hawkish shift that can occur from this meeting is if the Fed, that can provide a great opportunity to buy at market, is if the Fed decides not to cut interest rates at this meeting. Now, we know that a 25 basis point cut is the expected outcome. So if they come out and saying, okay, no, sorry, we're not going to cut, that'll create a great buying opportunity for the US dollar at market, but that is a very unlikely scenario. Alternatively, a lesser hawkish shift that can occur is if the Fed does cut by the 25 basis point as expected, but the dot plot shows no more cuts expected by the Fed members in the coming couple of months, and Jerome Powell comes across more hawkish in his press conference by focusing his attention on the more positive developments in the economy and the solid numbers that we saw from inflation and wage growth. Now let's look at a possible dovish shift. The most dovish move from the Fed, which will provide a very clear sell trade on the US dollar, is if the Fed decides to cut by more than 25 basis points by cutting with 50 basis points or even more at this meeting. Now that again is a very unlikely scenario, as that 25 basis points cut is the expected one. So if the Fed comes out and surprises markets with a 50 or a bigger cut, that'll be a clear sell trade even at market for the US dollar. Alternatively, a lesser dovish shift can occur if the Fed does cut by the 25 basis point as expected, but the dot plot signals more expected rate cuts by the Fed members in the coming months. And if Jerome Powell comes across more dovish than the markets are expecting at his press conference, and places a lot of focus on the risks to the economy from the trade war, and chooses rather to focus on the negative aspects like manufacturing instead of the positive aspects that we saw recently. Now, we know what possible sentiment shifts we are looking for. And the possible trades that we can take is if we see a hawkish sentiment shift from the Fed, that'll obviously create a bullish move in the US dollar. We can look to pair the US dollar with the Kiwi dollar, which remains fundamentally bearish. Now, something that is important, however, is the risk tone at the time of the meeting is very important to keep in mind. If we see a very positive risk tone in the markets, that'll be more supportive for the Kiwi dollar. And if we see that more positive tone at the time of the meeting, we can rather choose or consider something like the yen or the Swiss to pair that with the US dollar in the case that we see a hawkish shift from the Federal Reserve. Now, on the other hand, if we see a dovish shift, a sentiment shift from the Fed, we can look to pair the US dollar with something like the yen. The yen remains a fundamentally bullish currency due to the ongoing concerns in the global economy as well as the ongoing US-China trade war. However, as we just mentioned, the risk tone will be particularly important going into that meeting. If the risk tone is very positive at the time of the meeting, then a better option would be to pair the US dollar with something like the Australian dollar, which has remained fairly well supported in the last 2 weeks and should see further gains if the risk tone stays positive at the time of the FOMC meeting. And now we can look at how we can actually trade this. Now, this event is valid for trading phase 1 trades if we get a clear sentiment shift. Now, a phase 1 trade is something that is that initial sentiment shift, that it creates that initial sentiment shift, either positive or negative, and you can basically jump into the market and trade that event. If you want to learn more about how this phase 1 trades work, definitely check out the news trading strategy playlist on our YouTube channel, where we post weekly examples of how these types of trades play out. And if we do get that phase 1 move generated by a sentiment shift, then we can also look for a phase 2 pullback of that initial move. Now, we post updates on these moves inside the tradable sentiment shifts report inside the Forex source terminal under the market insights tab, and you can see each day which sentiment shifts are in play and which ones are still valid for trading the phase 2 pullbacks. Now, you can also learn about how these setups work during the live analysis webinars that we run each day inside the Forex source terminal. Guys, thanks for watching. As always, please keep your questions coming. We are busy making a lot of videos from the awesome questions that you guys sent us in the comment section, so please keep them coming. And also, if you found the video helpful and the content, please give us a like, give it a share, and we'll catch you guys in the next video. Cheers.